Alright, let's get it. This is going to be about market conditions and how I use it to filter price. And what that means is just what I look for when I open the chart. I want it to be clear, concise, and obvious. If I am unable to have if I go into the day and I don't have a clear, easy direction of where I think price is going, that is a sign for me to already not be interested in price. That doesn't necessarily mean it can't change, but typically I want to be already having a good rounded idea of where price is going to go. This is the three things that I look for that I learned from Kiko and AM Trades. This is where all of their foundation comes from. This is where I have found the most success trading. And this is what I deem high probable environments. Willingness to break through relevant levels. And don't worry, I'll show you guys examples, of course. I also wrote down a few chart examples because that is personally how I like to learn as well, seeing them on the chart, not just in a PowerPoint. But willingness to break through relevant levels. What does that mean? So hopefully you guys have either watched at least one of my reviews or seen in chat that I've marked out relevant swings or relevant low, relevant high, failure swings, whatever. If when you're looking at, and if you were also a part of the ICT class that TT taught or Ink Capital, he told you guys that the extremes of the ranges is where that's going to be your external range liquidity, but it's also going to be where you find the most reaction. And so when I find an extreme of the range, which is what I deem a relevant level, it's all the same terminology. I want to see price. If I'm looking for a continuation, that is what I trade. I want to be trading the expansion phase of price. When I'm looking for a continuation, I want those levels to be broken and then held, and then another order block formed through that to be able to enter and have that continuation signature that I always talk about. No deep retracements. That is a classic signature of an expansion phase of price. And I can show you that as well, of course. And the last one would be how volatility drivers affect the market. What are volatility drivers? On the right, there is the roadmap. That is what I look for every week. That is forexfactory.com. You uncheck everything besides USD currency and the red folder news. I do not look at orange folder. And you can have the white one turned on. That will just tell you when the bank holidays are on. But high impact news and how that affects the market affects how I'm trading and what I'm anticipating and where I'm anticipating volatility to be injected into the market. And that is telling me two things. Is price willing to go higher or lower or continue? And if price isn't continuing, is price manipulating a relevant level or an external range liquidity where I can then form a reversal from? And so that is going to be your 8:15 news. In this case, we have unemployment or NFP week. That's what this is, as well as FOMC. That is typically not something that is often, right? We don't have the meetings that often, but what you're looking for is 8:15 sometimes. Primarily, it's going to be 8:30 and 10 a.m. And then 9:30 is always going to be a volatility driver. It's going to be a volatility injection just because that is your opening bell of the equities market, of course. So take into account the red folder news events throughout the week. That is going to be how you should be expecting where volatility is going to be hitting the market. And that is your roadmap. With this, you can assume when expansions/volatility should hit the marketplace. This is what I mean. This is a perfect example of when I'm looking and hunting for trades in a low resistance environment, when opposing candles are being respected, when you have clear, concise highs being rated and rejected, and lows being displaced through in this case because this is a bearish example. And that is a classic signature of a bearish expansion phase. And this is what I deem ideal conditions or an A-tier environment. Large daily candle bodies. You guys see this over here? This is what I mean. Notice how price is expanding away here. Then we have this potential reversal. Why are this potential reversal here? Well, notice the spacing between this low, and this low. Ideally, they all get ran out, but this could offer a potential retracement, which it does. Notice how price closes beneath this next opposing candle. That would be your continuation signature. And then price ends up hitting that extreme in the range. Again, this is what I want to be trading. These are the days that I want to be a part of. These large candle bodies. Again, large candle body, large candle body, another large candle body. Why do I want to be a part of a large candle body? That is the classic signature of an expansion phase of price. That is going to be your low resistance conditions. Never trading away from failure swings. For the most part, you do not want to be doing that. There is a few examples, which is a more advanced concept, where sometimes price will leave failure swings. And that you can either choose to trade away from them, or you let price go and you miss the move. It's up to you. I'm not going to get into how you can trade away from it just because it's not important right now, but pretty much for the majority of the moves that you're going to catch and that are going to be the easiest and the lowest resistance, you're not going to have failure swings on either side of the range. They should be cleared out, and it's going to be nice, smooth from one external range to the other external range, which is just relevant level to relevant level. No deep retracements. This is the perfect example of no deep retracements. The candle body opening price is respected almost to the penny, and price expands lower. This is something not really ideal, but this again never broke this high. And if we would measure from this high to this low, which would be their current dealing range, the 50% would be somewhere up here. Price never even taps that and then comes down below. All it does was sweep out its previous daily high and then goes lower. So this would still typically not be a deep retracement, even though this is a little bit of a larger wick than you typically want to see. This is a perfect candle up here, that this is sort of what you want to be trading. And again, I know this is just a little bit of a harder visual, but notice I have this high annotated because it sweeps out its previous daily high, closes back inside the range. And again, if you've watched some of my reviews, I want to see that if I'm looking for a continuation, I want to see that 50% of this wick be respected. And if we estimate that and just draw this out to the right, you can see this wick was created below the 50% of that. That is forcing a small wick it's forcing a small upper wick, which allows for what? A large candle body, which is expansion. And this is the most important part. The clearest opportunities lie in the extremities of the ranges, which is just your external ranges of liquidity. This is a daily perspective and a 4-hour perspective in a high resistance trading environment. The daily chart, notice we are leaving failure swings. Price is in a higher time frame range, and it's failing to break out, and it's failing to choose a direction. Right? This is just a consolidation phase of price. This is not something that I want to be a part of. Notice how once price is taking out this high, this next candle, instead of opening high and respecting that 50% of the wick and then potentially forming a trade down into these lows, it's opening low, failing to take these out, and then closes back above. That is different than what we just looked at here, right? Notice that 50% forcing a small wick, allowing for a large candle body. If we look back, notice this, right? Bearish candle, it wants to be opening high first before then going lower. But this is just very nasty. Failing to break out above the highs, leaving failure swings, not what you want to be a part of. 4-hour perspective, same concept, just on a little bit of a smaller time frame. And this is what I mean, right? If we are bullish, which this could potentially, we're making lower highs, right? But notice how we take one swing high, come back inside the range. We take another swing high, come back inside the range. That is not what you want to be seeing. You want to see candle closures above the highs consistently with no deep retracements. And what do you notice? We take the high, deep retracement. We take the high, deep retracement. Not what you want to be seeing. High resistance trading environments. This consists of price breaching its ranges, highs and lows, while continuously returning back to equilibrium of the range. And so, in this case, again, price is failing to break out above the range high, which was this before price took this out, and this is the range low. Price leaves equal lows, fails again to take this high, and then breaks the low. What do you notice? This is equilibrium of the range. Price is just continuously bouncing over and over at this. This is a classic phase of consolidation. And what do you notice after the extreme of the range is broken, right? Even though we take it here, then this on a lower time frame would have never offered you anything. So once you run out the low one more time, then guess what? Look what there is, right? What is this? A small lower wick. What does that allow for? A large candle body. And then you can see continuation higher. And what do you notice? This next day most likely probably continued because it closed above this high. This typically gives you poor lower time frame action where nothing is clear and decisive. That's exactly what I don't want to be a part of, because on the lower time frame this is even sloppier. It's obviously easier to see here and once the moves are passed, but trading consolidation when you're in consolidation is pretty tricky, because especially on the lower time frame, and I mean like 1 to 5 minute, everything looks like it could potentially have a move. And that is why I stress that if you do not have a daily bias formed from a relevant level, an extreme of the range, external range of liquidity, or a previous day high or low, something like that, I do not want to be trading typically. During these conditions, no risk should be put on, and price should be avoided until a direction is chosen. This is where it's hard, because look how many days of price were inside a range. Typically, and even myself, this is hard for me to sit on my hands. As I'm developing, it's gotten a lot easier, but when I was, especially last year, pretty hard for me to avoid chop, because I would get into my own head, go into the lower time frame, and think that something's going to happen. And I'm telling you guys, the extremes of the ranges, your external range of liquidity, once you let those get hit, you're going to have a lot easier time finding low resistance trades. Alright, this is the first example of what I mean by a willingness to break through relevant levels from a 15-minute perspective. And this is something that I actually took. I remember taking this trade. And this is a perfect example. So when you are anticipating continuation after a relevant level is met, you have two questions to ask yourself: breakout or reverse. That is all that price is going to do. Once a relevant level is met, there's only two things that price can do. It's either going to break out or continue, or it's going to reverse and retrace into something below. That's all it does. It's constantly seeking liquidity, expanding, or retracing, or reversing. That's it. That's all price does. Once you put it in that perspective, and you understand whenever a relevant level is met, that you have to ask yourself, a new phase of price is possible. So, in this scenario, from Friday, December 12th, 2025, I was looking for the daily swing low at 25,193. That's what this drawn liquidity is down here. And I could show you guys this if people want in the actual chart, but this is how I derived my bias and what I was looking for. So prior to that, the 4-hour lows were taken, which is delineated as relevant low. So this is the only place that I have deemed relevant. Why did I deem it relevant? Which I'll show you guys again, and also TT explained to you guys. This is just the extreme of the range. This is the only low in a bullish scenario that could possibly offer a retracement or a reversal back up higher. Not a retracement, a reversal. This is the only low that could possibly offer a reversal back to the highs above. That's it. The only place. No fair value gap. It's a low. We're looking at lows and highs. If price is going to continue to my daily draw, there will be no deep retracements, and a continuation signature needs to be created after the 4-hour lows get taken. So I missed the entire move down that was already happening. And this is exactly what I'm going to be seeing. Notice how price isn't largely back returning into the range. Notice how price is respecting the lower portion of this fair value gap, right? The 15-minute. This actually might have been from a 5-minute perspective here. I think that's why the 15-minute fair value gap is a little drawn weird. You can tell, and if you guys continuously study price, if this is our 15-minute fair value gap, we want to be seeing price stay in the lower half of a fair value gap. Typically, when I say no deep retracements, obviously depends on your time frame that you're looking at. But the most important thing that you guys can look at already in your charts is if you mark out fair value gaps and you see candle closures consistently either closing beneath the fair value gap low or consistently closing below the 50% of the fair value gap, that is a good sign that you're on sides if you're looking for shorts, and vice versa if you're looking for longs. If price is staying in the upper half and price is continuously closing above that high of that fair value gap. That's what I mean by no deep retracements. That's why I was so confident in this trade. Everything aligned that I was looking for. If one is made, that is where I would be hunting for my continuation entry. Ideally, I wait for a 3 to a 15-minute fair value gap to get tagged, and then an order block to be created out of that for my entry model. That is the easiest way to have a designated stop loss with a true invalidation point. That is why I trade order blocks, because a fair value gap can get ran through. Typically, there is a way to sort of tell where price shouldn't go, but that is why I like to have order blocks, and that is mostly why and how I can get better risk to reward trades. In this case, this is exactly what I'm looking for. 15-minute fair value gap, bearish fair value gap getting hit. That was created after my relevant level was met. Price has no deep retracements, gives me that continuation signature, which is that closure below this last up close candle. That would be my bearish order block. Getting that closure there, I'm short. Stop loss at the high. Now I'm looking for my draw, which is this low, which is the last relevant level that I could potentially see price reversing from. And in a bullish market, in a primarily bullish market, you have to most of the time you have to have conservative bearish targets. But obviously that is why you can hold runners, etc. But that is why I typically either take off my full position or I take off 70% of my position when a relevant level is met when I'm trading against the higher time frame trend. This is what I mean by a failure to break through key levels. So we just looked at a willingness to break through key levels, right? This is that relevant low that price had no deep retracements in. Bearish 15-minute fair value gap, continuation signature created. That is how I entered that trade. This is a failure to break through key levels. When looking for an expansion or a continuation, you don't want consolidation after a relevant level is reached. And that is exactly what you guys can see here, right? That's not what you want to be seeing if you're looking for a continuation. You do not want to see consolidation, at least for a day trade, right? If you're looking at the daily chart, obviously that's different. But ideally, that's not what you want to be trying to take a continuation setup from. And you should be demanding expansion through highs or lows for true breakouts. The longer price takes to create a PD array through the objective, the less likely you want to be a part of that move. Multiple failures of creating a change in the state of delivery through a higher low shows that price is not in a hurry to continue to expand. That is, if you guys learn anything from today, please screenshot this, write this down, whatever. These last two boxes. That is what has helped me take a lot less unnecessary losses. And I learned that like 6 months ago. Notice how price takes out this high. And this is just a random example. I'm not sure what time this is, but I'm sure this is probably later in the day, etc. Notice how price takes this out and has a deep retracement into this fair value gap leaves this one below, then closes above here, a lot of people could potentially long that, and this is what a classic continuation setup looks for me. But in this context, you can see in this case it doesn't work, and you can see all the consolidation follows, and that most likely means that there's going to be some sort of retracement into what most likely this fair value gap or these lows below. This is not what you want to be seeing when you're looking for a continuation. This is what it looks like when price is failing to break through a key level. And this is a perfect example of a trade that I actually took, that I lost on, that is completely okay, and this is what happens sometimes. Price will not always follow through. There's ways to gauge where price is likely to continuously expand or whatnot, but in this case, we're going to keep it very straightforward. Shortly after 9:30, that is our volatility injection, right? That's our equity open. You guys will see if you guys go into your charts after this and just study and look at the 15-minute or the hourly chart. Just go in and look at how many times of the day that a 9 a.m. high or low is put in. That is a little bit of homework for you guys. Price puts in a swing point, breaks through the high, and then another order block is put in. That is a continuation signature that you can use as an entry. Or in this case, you could long the fair value gap with a stop loss down here, but then you have a little less defined risk, right? That's what I mean. But in this case, where price just fails to break through the key level, sometimes you will do everything right, and it will not work. This is the same type of trade idea as my winners, but this one didn't work. That is a part of trading. This is exactly what I deem A+. This was, I remember this. This was, I believe there was a 15-minute fair value gap under here. Price stabs into this low and the fair value gap, closes above, and yes, you could just long this here. Depends on your trading style. But since the relevant high was already close, I chose to ignore this and then wait to see if we would continue higher. We get this closure above, and I'm long off the retest with the stop loss at the low. I get stopped out immediately. It ends up making a new high and then reverses. It is what it is. Sometimes you will do everything right and you will lose. That is trading. Volatility drivers are used to form reversals / continuations. This is where we will get into those V-shaped signatures that I always talk to you guys about. Snappy, rejections, moves, those are the ones you want to be a part of. You want the drivers, so your 8:15, 8:30, 9:30, 10 a.m., that's going to be your, and sometimes 9:45. Normally that's not really high impact. It can be. Those are going to be your main times where you could be looking for price to put in a swing high or a swing low to potentially trade away from. You want them to make sharp, snappy moves that are formed at key times. V-shaped reversals. Expansion met with expansion. Another thing I want you guys to write down, if you take nothing away from this, please take this with you. V-shaped reversals, expansion met with expansion. And this is exactly what I mean, right? This is our high. 9:30 comes up. What does this look like? A V, an upside down V. Whoops. An upside down V. And what? Price is expanding, and then price expands back below. That's what I want to be seeing. That's the moves that I want to be a part of. The market should expand rapidly in one direction with minimal retracements. This is a classic expansion day. This is what I would deem a high probable trading day. This is a low resistance environment. See how lows are being rejected, or highs are being rejected, lows are being broken through. Continuously one-sided order flow, right? There's not a lot of up close candles here. That's what I want to be seeing. Dominant one-directional moves. This will be indicated by an overwhelming amount of bullish or bearish candles in one direction, depending on the trend you are engaging in. Again, in this case, what do you notice? A dominance of black or down closed candles, bearish candles. That's what you want to be seeing. Continuous candle closures below old lows, below up close candles. That's what you want to be seeing. Those are expansion signatures of price. Notice how fast price is expanding. Notice how we're not hanging around our objective very long, right? This is only 5, 10, 15 minutes, right? And then price is expanding lower. Expands lower all day. That's what you want to be seeing. You want to see snappy, fast, one-directional moves. Notice the dominant one-directional move. See how the continuation was put in shortly after 9:30, since a reversal was already established. And again, that's a little more advanced, but in this case, we already had a potential protected high. Price just had one more stop hunt, and I trusted this because of the higher time frame. In this case, you can't see that just because this is the lower time frame. But short little stop run, V-shaped reversal, expansion met with expansion, continuation signature put in quickly. That's what you want to be seeing. Notice how it's not consolidating when I'm looking for that continuation, that closure below. That's what I'm looking for in price. This is the market when it looks like it has ran out of gas. And this is derived from Kiko. All credit to him. But this is a perfect example of what I look for when I don't want to be a part of price. Even though the drawn liquidity is met, notice the difference between this move and this move, right? It's clear as day. Notice all the consolidation. Notice the deeper retracement here. Notice the wick, the weird wick. Not large candle bodies, not a dominant price run, right? Even though it goes up, it's a lot of consolidation. If we look back here, what do you notice? Larger candle bodies, a larger sharp move, right? That's what you want to be seeing. This is an example of a tradable day, but is it worth the headache? That would be up to you guys to decide. You can still make money in this. It is very possible. We still have framework here, but this is typically something that I do not want to be a part of. Notice how lethargic price is. That is what we just went over. Notice how there's not large candle bodies. Again, I just want you guys to continuously study how the candles are printing when you're in a trade. Notice the absence of a snappy move or a very dominant price run. Notice, even though this is not ideal, this would be like a C or a B level environment. Notice still how the relevant level is met and we get that V shape. And what time? Right after 9:30. That's what I want you guys to start noticing. And then notice how long price takes to deliver, right? This is 9:30. You can see this dole is not that far away. And it took 3 hours for price to hit it. These are all things I want you guys to become aware of. Then you can create your own system around the conditions you prefer to put on risk. And that's exactly what I just said. You guys can obviously all trade different. We all trade different. We always will. I want you to take this information and create your own playbook. And whatever you're comfortable with taking, that's what you guys should do. And use your entry model for that. Now this is an example I am in a day that I am completely avoiding at all costs. First of all, you guys know, if you've watched my recaps and seen what I preach, I do not like to trade when there is a large opposing run. And in this case, if we're looking for buys, this is not how I want to see the action pre 9:30. I don't want to see a knife straight down, and even worse, it left the relevant low behind. This is the 9:30 opening price here. Notice how price does nothing significant. It doesn't break the lows. There's no SMT down here. And there's no significant change in the state of delivery. And notice what price does. Notice how there's no V shape. Notice how the relevant low is left behind. Notice how it's consolidating almost the entire time. Not a one-directional dominant move. Obviously, it does straight go up for the most part, but it's a consolidation. Notice all these little candle bodies here. And then look how long it takes price to reach the extremity of the range. Right? It literally took price all day to get up here. Again, If you want to trade this, by all means, you can. If it works for you, do what you want. I personally do not want to be a part of this. No relevant or the relevant low was never taken. No dominant one directional move. Consolidation on the entire move higher. Takes price almost all day to reach the range high. That is what this is the day that I'm avoiding at all costs personally. Recap. What to look for. This is a checklist that you can either write down or just look. You don't obviously have to implement it in your trading. The higher time frame needs to be in an expansion phase, and it needs to be working off of a relevant level. Reversal / continuation put in at a key time. What are our key times? 8:15 sometimes, 8:30, 9:45 sometimes, 10 a.m., 9:30. What am I looking for when I'm either looking to be a part of a trend, or what I'm looking for and the feedback when I'm in a trade? I'm looking for a dominant one directional move. When in an expansion phase of price, and you will know that if the daily candle you're trading has a small lower wick, there should be no deep retracements. What I want to be looking for: price is delivering quickly, ideally after a volatility driver or after 9:30, which is a volatility injection. That is the PowerPoint, and we can go into some. I'll show you guys the 4 chart examples that I have on the charts. And before that, do you guys have any questions? Change my screen real quick. Any questions? Let them rip, fellas and ladies. Can we find the slideshow? Yeah, I can share it with you guys. Big Zoop. Which part do you want me to show you on a chart? I have 4 examples and I'll show you guys that I wrote down. But do you remember? So I wasn't looking at chat when I was in here. We're not done yet. It was the first slide, I believe. So like the checklist that I'm looking for pretty much. Today, I'll show you guys literally the trade that I should have been in today that I missed. What's considered shallow retracement? I'll show you that in the chart. It's easier to see in a chart. But shallow retracement, I normally will be when the upper half of fair value gaps are being respected, and when you don't see the upper half of a fair value gap and the upper portion and the 50% and above of an order block should be respected. That's what I mean by no deep retracements. Like this, which I'll show you guys right now. This is an example of today. And a lot of people, even myself, I'm a little more skeptical on a day like today when it's FOMC and earnings season. I'll make it simple as possible as of now, just because I don't want to get too in depth, but there was no daily wick on this candle today when I opened the charts this morning. So when I see that, that typically means that price can potentially go back to that new day opening price. And when we have all-time high up here, which was taken, if we play price, it was taken early on in the session. The 4 hour is easier to see as of now. So price was taken all-time high early on in Asia. And if we look at NASDAQ, we have SMT up there with its all-time high, right? SMT just means, for anybody new, when one asset fails to do pretty much the same thing as its correlated pair. So that would be NQ and ES, which is just SPY and QQQ. When NASDAQ is failing to take its high, which is up here, while ES is taking its high or all-time high, that's where you can just stop and say, okay, potentially, since we've been expanding, price could either cool off here or reverse. And that is what I mean when I say a relevant level. Notice how this is at the extreme of the range. This is all-time high. So already you could be expecting a potential retracement or a reversal, because when a relevant level is met, a new phase of price can occur. What are your phases of price? Consolidation, retracement, reversal, expansion. So when I saw that and I knew that there was no daily wick, now I'm going to the lower time frame. And I looked at ES, and I should have shorted ES because it was the weaker asset and it was closer to its daily opening price. This is what validated what I was looking for today. When you have this potential daily reversal, we're looking for that change in the state of delivery. That is validating that this high up here could be a protected high until our drawn liquidity is met, which is the daily open. Because why? Well, we've been in a trending market. There's no reason to fight the order flow. There's fair value gaps down here on the daily. Down here, there's 4-hour PD raise down here. There's 4-hour lows that price could reverse off of. There's not something that we want to be holding our trade, our short, too long for, right? That's what I mean by you have to have conservative price targets when you're trading against the higher time frame order flow. This is an hourly change in state of delivery. That's what I'm looking for. That's giving me that light bulb moment, but now because that this high could potentially be protected. We go in. Now this is the reversal. I personally do not trade reversals, especially when price is in a trending market. I like to look for the continuation signature. This is where I went down to the 15-minute. Normally I like to go from the daily to the 4-hour to the 1 hour if nothing is really relevant on the 1 hour, but in this case it was. We got to have our hourly change in state of delivery with that hourly fair value gap. That's where I'm looking for price to reject from. And again, in this case, notice from this range high to this low, I don't really want to see price getting above or having a deep retracement into the 50% of this range. Notice how price stops here, closes beneath here. That's what I'm looking for. That's what I mean by no deep retracements. This is perfect. Notice what time this is occurring at, right? And this is what I mean. In this case, price is having an opposing run before giving us what we're looking for. So now what do we have? Well, we're inside of that hourly fair value gap, that bearish hourly fair value gap. That's what this gray box is. Now we have a 15-minute swing high or internal range of liquidity that you guys hopefully remember is getting ran out with respecting what? The 50% of this range. That is everything that I look for. And this is paired with what? Shortly after 9:30. What do you notice? After all this is met, we're getting that snappy rejection lower. We're getting what? Expansion met with expansion. And this is something that I'm looking for. In this case, this is consolidation on the 5-minute. But if you trade it long enough and you are comfortable and you see this consistently, this is what I'm looking for. As soon as price gets this closure beneath here, that's what I'm shorting. This is everything that I look for. And pairing that with no daily wick, this is why I should have been short after this. Or you could wait for the 15-minute change in the state of delivery, which is even cleaner, and this would be more supportive of what we just went over. Notice how there's that expansion after 9:30, and it's met with what? Expansion. What do you notice? An upside down V, right? That V-shaped signature. That's exactly what we're looking for. In this case, normally the price would just continues lower and leave you behind. In this case, it's FOMC morning, so price retraced gives you that optimal entry and then hits our drawn liquidity. This is a perfect example on a day where you potentially could be a little on edge or a little more defensive than normally, and it still works out. And the same thing occurred on NASDAQ. there's that same daily opening price. Just a little bit different on NASDAQ because it didn't have that hourly fair value gap. And so that's why I was a little frustrated with myself today. But same thing. All it was waiting for was ES to get into its hourly fair value gap. And in this case, it gives us that 5-minute change in the state of delivery. I took this on paper after I took my loss. Entry there. Stop loss above here. Why is my stop loss here and not here? Well, in an expansion phase of price, I do not want to see deep retracements. Sometimes you'll get stopped out. It is what it is. That's what I mean. That's going to happen. And you'll get more comfortable and more familiar with when to put your stop at the high or the candle body, when you can squeeze risk, when you shouldn't, etc. But this played out really nice. That offered a 3R. And again, what do you notice? After this small consolidation phase, we have a pretty dominant price run, even on the morning of FOMC and with Mag 7 earnings in the aftermarket. So that is just an easy example from today. Little more advanced just because on the 5-minute it doesn't really, this is not something you typically want to see, but the 15-minute on ES today was absolutely perfect. So if you want to study something, that could be today. I have another example, a long example set up that was actually from yesterday as well. I missed this one because I was trading gold instead, but I can show you guys that, and that was on NASDAQ as well. That was absolutely beautiful, and I'll show you guys the framework from top to bottom. So here is the drawn liquidities up here, right? Price took out these lows here on Monday, expands higher. What do you guys notice? A little more advanced here, but notice how when I told you guys earlier, this is what I mean by the 50% of the candle body's range. When I'm looking for a continuation the next day, I'm looking for this upper portion of the candle body to act as support for price. Because why? It forces a small lower wick. What do you notice here? A very small lower wick. What do you notice? Large candle body. That's what you want to be part of. So seeing that, understanding that, what do we know? What do we have? We have a clear invalidation point, which is down here. Price, this is the only other level after this one that price could reject from and reverse back higher. In this case, obviously, you don't want a deep retracement. So even though this is still above this 50%, ideally the upper fair value gap is respected. It does. From a lower time frame perspective, this is how you can trade this. Notice how we have a bunch of floating lows right before our key level, right? And again, from the homework that I told you guys earlier, go back into your charts, use the 30-minute, hourly, 15-minute, whatever time frame you want to use. Look at how many times a 930 low of day has been printed and price just expands away from it. In this case, price is not manipulating a extreme of the range. In this case, all it's using is a 4-hour fair value gap. This is just trading the continuation. This isn't trading the extreme of the range, right? This is different. It's the same concept. It's just different in this case because you're just using a 4-hour fair value gap as our key level. In this case, this is exactly what you want to be seeing. 930, our volatility injection. Price has that small opposing run into our key level. We should not be looking for longs until this 4-hour fair value gap is hit. In this case, I typically like to enter anywhere from the 15-minute to the 1-minute during the New York session. I will use the 4-minute, the 2-minute, the 3-minute, whatever. It doesn't matter as long as my entry signature showed up. In this case, since I'm looking, everything that aligning is here that I'm looking for, I'm going to use whatever time frame is going to give me the change in the state of delivery that is going to give me the best RR and is going to give me the the best entry for myself personally. And I typically don't like to go beneath the 3-minute, but in this case, I was looking at the 2-minute today, and this is the perfect example. Run lower, and this is where you could enter above here. If you would use the 1-minute, you could get filled right here. You could enter on a market buy with a stop loss at this low, and you could be targeting these highs, which is a very nice trade. It's a 2R. But in this case, a little more advanced of an entry. You were just taking this first opposing candle. And this is what I missed out on when I was in real time. You are assuming that this low down here is protected. Why is it protected? We have a strong draw liquidity that is still open. We have a relevant level. The 4-hour fair value gap is our higher time frame key level. Instead of a higher low this time, it is a 4-hour bullish fair value gap. What do you notice? You have expansion lower, a fake out if you want, or what ICT calls a Judas swing, and then you have an expansion back up. What does that look like? A V shape, or if you trade retail concepts, a tweezer bottom. That's what you want to be seeing. What do we have? An opposing candle formed, a fair value gap gets tapped, a closure above. You can be long with a stop loss at this low. If you want to be a little more conservative, you can long here with a stop loss at this low. That still offers, if you ask me, great risk to reward. If you're unhappy with almost a 3-hour trade, you're in the wrong business. If you are going to be a little more advanced, this is a 5-hour trade. In this case, what do you have? A dominant price run, a one-directional move. Notice how this candle here, even though this is a 2-minute time frame, notice how price is not stabbing into all of this lower fair value gap down here, or this one. It's leaving them open. That's what you want to be seeing. If we continuously play price, what do you notice? A little bit of consolidation. Price is expanding. And if you look at the 5-minute and we play price, the draw gets met. Obviously, this is not ideal either. This took a lot longer than it should have, but typically in a perfect day, you're going to see a reversal put in, and then through 10 a.m. from 9:30 to 10 a.m. prices are just going to expand straight to your drawn liquidity. It should be very fast, but that it's still. And typically, if I was in this, I wouldn't be holding for the entire draw either as well. I'd be out a majority of my position at a 2R. So in this case, would have been up here. So you wouldn't even have to wait for the strong liquidity, or it would be even sooner, obviously. But this is what I mean. And your draw doesn't have to be met, even though it eventually does. Your draw doesn't have to be met for you to be putting on a profitable trade. And there's ways to get around this as well, with understanding, which is more advanced, understanding hourly candle closures, and if price is not continuously going to trade higher, you can have timed exits, which is more advanced, but you could potentially take a partial at like 10:30, whatever. But this is a great example of our key level being met, 9:30 giving us that opposing run before giving us that V-shaped bottom, before giving us an expansion higher. This is a trade that I would 100% take that I accidentally missed yesterday because I was trading gold. Now for the bad examples, this is a failure to break through. This is from January. If we go to January 15th, we go back right here. Notice what we're in. Price is failing to pick one side of the range. And the only thing that you could do here is potentially look for longs because all of these lows were taken out. So from a daily perspective, you could be bullish into these highs above here and above here, because this is a failure swing to this. Notice how there's not a lot of spacing between these highs. So going into from the, obviously this candle's not here yet, but from the 4-hour perspective, we can see that this is what price was looking like. If we just go to the new day open. So this is our relevant level. And so if price is going to continue, it should just continue. We don't need to break this low. This day, Tuesday, or Wednesday had already taken out this low. So Thursday could possibly trade higher. Well, on the 4-hour, do you see anything really meaningful? Yeah, well, what do you notice? Again, you get some V-shaped signatures. You have a 4-hour fair value gap above here. That is all good things that you want to be seeing. But now this is just during the, now we are during our New York session on the hourly perspective. We can play price back here. This is everything that we want to be seeing. But in this case, I'm waiting for 9:30. I don't trade pre-market. I'm waiting for 9:30 to potentially continue the already established reversal. Again, what is this? V-shaped bottom, expansion, met with expansion. This is what I want to be seeing. So this is how I could be looking for a long trade into these highs, into our high of the week so far, and the failure swings above. And all I need for an intraday level is an hourly or above PD array. Personally, that is what I look for. If we play price, this is not how I want this candle to be opening. And what do you notice? We have relative equal highs on the hourly. If I'm bullish here, I ideally want price to open lower first into our key level, and then price can expand. Even on the 15-minute, what do we have? A 15-minute fair value gap, which can also be used, right? If you're trading from New York session, I will also use a 15-minute fair value gap. What do you notice? This is smooth equal highs that could possibly offer some sort of resistance. Notice how price is closing beneath this fair value gap. Notice how price is not tapping this and just immediately retracing back up. Notice how all these candle closures continuously are failing to pick one direction. Even if you look on the 5-minute, is this something that you want to be a part of? If we look at 9:30 and we're looking for a continuation, do we ever get a candle closure through here on the 5-minute after the 15-minute is tapped? No. Notice all the consolidation after this potential speed bump. That's what I like to call these, because it's not a relevant level, but is potentially could be a place where price could slow down at. And that is also due to the fact that price has already expanded overnight. So that is why you have to be a little more cautious going into the day. That is also why I personally wanted this hourly fair value gap to get hit this day. Notice how price pretty much does nothing. This is exactly what I mean by prices failing to break out above this level. This is what you do not want to be seeing when you're looking for a continuation into highs above in a bullish scenario. If you look at price from this perspective, from an hourly perspective, price retraces into this lower fair value gap down here. And in this case, going back to somebody's what do you not deem as a deep retracement, from the range high to low, notice where price stops at, right? This is exactly what you want to be seeing. I do not want to see price make a deep retracement below this 50% of the range. This is the only level here that I'm looking for price that it could possibly trade into before I'm uninterested. Does that mean price cannot go up? Of course it can do whatever it wants. It's just not something that I want to trade. And notice this day, right? This day does nothing. All it does is go lower and just sets up the next day. And what do you see here? This is how your trade becomes invalidated. This is exactly what I mean. This is the only last place here that I would potentially allow for this trade to reverse from. This is the only level at the 50% of the range inside this fair value gap. Price fails to do anything significant, consolidates, and then gaps lower. That is, unfortunately, this is a gap, but price never gives us any sort of higher time frame, change in the state of delivery after this level is met, consolidates, and then price fails to go higher. And the last example before some questions, if you guys have any, from August 21st. Let's see. Is this the 25th? What is this? Oh, this is 2025. Okay. I was about to say, what? Alright. Old example because I couldn't find anything for the bear side. But this is an example of when 930 left behind highs and it failed to do anything significant. So if we zoom out, right, we are trading away from all-time high, and price has this low here and this low here. Those are the extremes of the ranges that I'm looking for price to potentially retrace from. And in this case, already, this is not something that you want to be seeing, right? Notice how price is closing below the 50% of this, not really respecting this, not ideal for a continuation. Ideally, obviously, still can go up. But if we go down to the lower time frame for the 21st, which would be here, this is a relevant level that is met on the 4-hour. Price could potentially offer a retracement back up, and then who knows, either go for the highs or reject. Why did I say it could potentially retrace? Because price could put in a high either inside of this fair value gap. Notice what I'm using, the 50% of the range. I want to see price put in a potential swing high here, either inside that fair value gap or at this high here. Those are the only two levels that I'm expecting price to hold if we're going to continue lower. And so, if we play price, this is also where I could be expecting price to hold from, because it's a 4-hour fair value gap here and a 4-hour order block. From an hourly perspective, what do you notice? We are in a consolidation phase of price. This is where you would want one side of the range to get hit. If we use our daily opening price, which would be right here, how do you want a bearish candle to form? You want it to open high, right? This is, notice how we take the high and then do nothing significant. Notice how there's no V shape. Notice how there's no expansion of the expansion. Already a warning sign that the day is most likely not going to do anything. And if we play price, what do you notice? Here's 7 a.m. Now we have now taken the range high over here, and we've taken the low, all before 9:30. And here is that 9 a.m. candle. If we break this down to the 15-minute chart, we have potential sell-side liquidity pools, but this is our main drawn liquidity down here, right? That is our extreme of the range on this time frame. This is what I want to see price doing. Here's 8:30. Now I'm waiting for 9:30, right? If this is going to be a breakout, if price is going to break out or reverse, what am I looking for? I want price to ideally respect this 15-minute fair value gap and then create that continuation signature below. Where is my invalidation point? Well, from this high to low, price could potentially put in a high from here and then continue higher. What does 9:30 do? It puts in our high. And from a 5-minute perspective, again, this is something that is tradable, but is this something that you want to be a part of? In my experience, no. Especially because if you look at the 15-minute, this is not how you want the opening candle to form. And if we continuously pray price, look what happens. This is the warning signs prior, just because of the consolidation. This is what I mean by you guys will find your own thing. The consolidation of all the way up here on this and the daily candle and the failure to do anything significant before 9:30, that is not what I want to be seeing. And so going into 9:30, you could possibly form a trade here, but is it worth it? If you would have never went break even at this low, you get stopped out. And then price, again, consolidates. I think it eventually goes lower. I'm not sure. I don't remember. This is from last year. But is this something? This is what I mean. So yeah, it doesn't go lower. It never ends up taking out the low. And this is a hellhole of a time to try and trade in. Leaves the low. Leaves all these highs above here. Not something that I want to be a part of. You guys have any questions? Would you long that at any point? Personally, no. I would skip the day. But again, this is. I mean, if you look at ES, maybe it took the low. No, ES never took the low, so definitely not. This is something that I just would not trade. And I don't think there was any follow through after this, really. Yeah, no. Price ended up just coming back to the 50% of the range. I don't. Let's just continuously pray this. Does this end up going lower? Let's see. No, I don't think so. Oh, maybe. Wait a minute. Okay, yeah, it does. So this is, yeah, that's what I mean. It's very indecisive here. Anybody have any questions? Sorry for this is a pretty long one, but hopefully you guys enjoyed it. Hopefully I maybe gave you guys a little bit of clarity. Everything's recorded. I'll put it in the recording session. Yeah, no problem. Zoowop. Thanks for being here, bro. You're welcome, chef. All right, guys. Good night. Thanks for stopping by. Of course. See you guys later. Good night.